And now for more on what's behind the Bank of Korea's rate decision today, we're joined today by Professor Shim Myungkyu, Associate Professor of Economics at Yonsei University. Professor Shim, thanks for joining us today.
Thank you for having me.
So this is the 7th time in a row that South Korea's central bank has kept its interest rate steady. What's behind today's decision?
The BOK's decision to keep the policy rate unchanged at 2.5% is actually widely expected when considering the current macroeconomic environment. On the one hand, inflationary pressures remain as CPI inflation rate recently came in at about 2.2%, which is slightly above the BOK's target, and there are clear upside risks due to rising oil prices. But at the same time, there are also growing concerns about slowing domestic demand and weaker global economic growth, especially given the uncertainty surrounding the Middle East situation. In particular, the uncertainty regarding the US-Iran war might drag down the global economy further, which can affect the Korean economy as well. So to me, and I think for most of the experts, the BOK seems to be balancing these two opposing risks, containing inflation while avoiding an excessive slowdown in the economy.
Right, and the Korean won came back down against the US dollar after being mostly trapped above the critical 1,500 threshold in recent weeks. Do you expect the Korean won to stay in this range?
The recent appreciation of the Korean won, bring it back to around about 1,471 range, seems to reflect partial easing of the global risk sentiment. Following the ceasefire announcement, financial market volatility has somewhat declined, which has reduced demand for safe haven assets like the US dollar. However, I would be a little bit cautious about expecting a sustained recovery like we have seen last 2 days. For example, the Korean won has already depreciated by around 4% since the conflict began, highlighting how sensitive it is to the global uncertainty. It has been found that when uncertainty rises, whether it comes from the geographical risk or global financial conditions, the Korean won tends to weaken due to investors' flight to safety behavior. Given that the underlying risks have not been fully resolved, as we see these days, Korean won could still face depreciation pressure. So while it may stabilize in the short run, I would expect continued volatility rather than a clear strengthening trend.
I see. And to contain fuel prices, the Trade Ministry announced a third round of fuel price caps yesterday and says it'll keep them unchanged for the next 2 weeks. So why is the government sticking with the current level? And has this cap on domestic fuel actually helped bring prices down?
Let me first note that the full price cap, the current policy, seems to have had the kind of the meaningful short-term impact in stabilizing domestic fuel prices. For example, if we look at the data, the diesel prices in Europe surged by more than 30% recently, but the increase in Korea was limited to around 8%, suggesting that this policy has been somewhat effective in containing price spikes. This has also helped moderate inflation to some extent. Even the overall inflation rate rose to about 2.2% in March, as I commented earlier. The increase could have been higher without the stabilization measures. So there are the underlying factors why the government, these are the underlying factors why the government wants to keep the full price caps. However, we also need to notice that there are some limitations in these policies. The policy does not address the underlying supply constraints, which is not the control of the current government. And as we have already seen some signs that prices can rise again because the situation in the Middle East does not seem to stabilize very recently. So overall, I would say the price cap is effective in the short run, but it cannot be the long-term solution.
Right, exactly. And like you mentioned, oil prices fell after the 2-week ceasefire was announced. Do you think they'll stay low? Because some analysts say it could take a year for prices to return to pre-Iran war levels, even if a ceasefire continues to hold. What's your take on this?
Yeah, I also agree with the kind of the idea, but the recent decline in oil prices following the ceasefire announcement reflects the improved expectations about global supply conditions. Investors are likely pricing in the possibility that energy shipments from the Persian Gulf will resume, which reduce the immediate concerns about supply disruptions. However, I would emphasize that this reaction is still largely driven by sentiment or expectations of the market participants rather than confirmed changes in the fundamentals. So, in fact, if you look at the data, oil prices have previously surged by more than 50% since the conflict began, which shows how sensitive the oil market is to the geopolitical developments. And given that the uncertainty about how stable the ceasefire will be, there is still significant risk that supply disruptions could reemerge. And that's actually what we saw yesterday as Israel attacked Bahrain again, and it impacted the market again. So while the recent drop in oil prices is kind of understandable, I want to say that it may be somewhat premature to conclude that the other pressure on the oil prices has fully resolved.
I see. All right, Professor Shim, thanks so much for taking the time today. We appreciate it.
Thank you.